All right, guys, this is being recorded, and at the beginning of every single webinar, I say this, and I'm never going to stop. Watch it again. If it's not even this short iron butterfly webinar specifically, watch another short iron butterfly video. I suggest watching this one again because some of those nuances that might be flying over your head or missing you because you're thinking of another question or something like that, when you watch it again, it'll all come through and you'll be able to remember it longer. If you wait a month down the road and watch another video or try to relearn, it is going to be relearning it. It's not going to be a refresher at that point. It's almost going to be like you're learning it again. But when you watch it relatively soon after, maybe a day or two, then it sinks into your long-term memory. All right. So please watch either this one or another short iron butterfly video that I've done. All right. My name is Eric Wilkinson. I got to get a couple of things out of the way. You might recognize me from mainstream media. I've been trading for over 25 years with my own money. I actually started out trading in college with some money I had earned, then moved to Chicago and started trading in the pits. I've traded everything from stocks, financial futures, commodity futures, and currencies, and all these products and options as well. This says any opinions, news, research, or analysis should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, what I'm here to do is teach you guys how to trade. I'm not here to give you investment advice. What I'm doing could be counterintuitive to what you're doing. I may say, go short Tesla, and you guys are long Tesla. You own like 30 Tesla cars or something. I don't know. So you obviously wouldn't necessarily want to short that. You might want to hedge some of those, but don't just necessarily lemming off the cliff with me. Take what I'm teaching you and implement it into your portfolio in your own way so that it's appropriate to you and your portfolio. And past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat. You can also follow us on Twitter at on Facebook at ProTrader Strategies. I do daily market commentaries and stuff like that. We're putting some of that new content, fresh content out there on Facebook so that it gets to you a little bit faster than the email. All right. So you can check it out right away. We're able to upload it and get it out to you a little bit quicker. So it's more relevant, if nothing else. All right, this video is going to be on the short iron butterfly. Now, if you remember, the core strategy here is basically we are looking at a market neutral strategy. Okay, so what I want to do with this particular course is not really set it up like we know exactly what our strategy is going to be before we get into it, because usually I don't walk into the day and say, I need to put on a short iron butterfly today, right? That never happens. You never sit there and say that. What you do say though is, well, I'm actually bullish in XYZ or ABC. I'm bearish. You know, I think the market's going to go down. Well, you could have this one, which is, you know, ZYX, let's call it, and it has a tendency to trade sideways, or it's kind of rallied up and it's kind of, you know, slowing down a little bit, maybe near a top. You know, a lot of times when we get to these tops, markets bang up and bang up and bang up, right? They kind of just end up trading in a bit of a range sideways. Well, that is kind of what we're looking for. So, you know, in a sense, we found ZXY and we found a situation where we believe it's going to start trending sideways. Well, then that's how we start looking for strategies, right? So we come up with our assumption, and then we need to find the most appropriate strategy for that assumption, because just because it's going sideways even, our assumption is a sideways market doesn't necessarily lead us back to the short iron butterfly, okay? There's a lot of other things that are going on around this stock that is going to determine us using the iron butterfly, okay? And I'll go through all of that as we're running through this process. But like I said, we have our assumptions. These are some of the things that we want is a range bound underline. So we have found something that is range bound, okay? Now we're going to start leaning towards the iron butterfly because it's range bound. The short iron butterfly is a short range bound strategy. There's a couple other ones also. The iron condor we did last week as well. The iron condor, and the difference between the iron condor and the iron butterfly, for one, you're going to get a lot better credit for the iron butterfly, but it's going to take a little bit longer for us to get to our target profit, all right? Our profit target, sorry. So, you know, they have the yings and the yangs on both of these. They're both range bound. Both of them also, short iron condor and the short iron butterfly, are also high implied volatility percent strategies. And I'll talk about high implied volatility percent quite a bit throughout this webinar. It's not just volatility, it's volatility for that underlying, really, is what it amounts to. And I did mention we are going to be looking for high volatility with this strategy because we want the collapse, or what we used to call on the floor, is to get that volatility crush. And it looks just like a chart also where you get volatility doing that and then boom. All right, so we're looking for that volatility to come out. You see that happen during earnings. We're in the middle of earnings. I mean, oh my gosh, there were so many earnings coming out today. I don't know if anybody had enough margin in their accounts to be able to trade everything. But we're looking for that kind of volatility to come out. Maybe not the crush you don't always get, but usually when you see the volatility come in, it comes out much more quickly. So we are looking for that volatility crush. Now, the way that we set up an iron butterfly, you can look at it two different ways. You can look at it as a short call spread plus a short put spread. You can look at it as a straddle with a long straddle, a short straddle with a long straddle. I prefer to look at it like it's a short straddle with defined risk. It's as simple as that, because also we are going to set it up from a short straddle and then find our defined risk on this particular strategy in order to build it out. It's much easier to do it that way than to try and put two call spreads together and just kind of go with that, or the short straddle, long straddle, and just go with that. I can make it a lot easier to explain using a short straddle with defined risk in order to build this out appropriately, right? So we came into this. One of the things is we aren't really sure we are doing the iron butterfly. So let's kind of mark that out for right now. Yes, of course, you guys signed up for this webinar because we're doing the short iron butterfly, but we're going to go through this as if we just are looking at X, Y, Z, and we need to go through these steps to see whether or not it's going to be appropriate for that underlying and this particular stock. Sorry, I can't stay, but we'll follow up and watch the video. Thank you, man. Watch it again, too. Watch it twice. All right. Anyway, so we are going to be picking the right underlying. That means when we are looking at the option montage, which is basically when we pull up our trading platform, we go over to the trade window, and this is where the option montage is. It's where all of the different option expiration cycles are. Now, for this rule, picking the right underlying, or knowing if IBM is an option tradable product, is really what I'm getting at when I say pick the right underlying. Is this underlying appropriate to trade options with? And how we find that out, because just because IBM's a big name, or even Aon, let's say Aon is a big name. I mean, everybody's heard of Aon, right? There's just not a lot of participation in the options over here. So with my rule, on any stock that's over $100, then we are going to need to look at the option pricing in relation to the stock. So what I do is, if it's a stock over $100, I move the decimal 3 ticks to the left, and that gives me, 19.5 cents, really, or we could call it 20 cents. So when I go down here and look at the options that are closest to the expiration, these are the monthly options. This is the spot month. That's where the most time and volume has been spent. If you looked over here at the time and volume, you'd see there's probably a lot more volume in this August contract than there is out here in the September. But having said that, we are kind of in a fluctuation where people are starting to roll those trades out to September, and it's quickly becoming the spot month. The spot month usually is the one that's closest to 35 days to expiration. So that's what we're going to look at. And when I move it over 3 ticks, we got 20 cents. You can see that Aeon kind of fits that bill. Make sure that this rule is applied during open market operations, right? We are after the close. And what happens to all our trades after the close? They get canceled. A lot of times Aeon will not fit this rule, which is the reason why I kind of brought it up here. It is fitting it today, but just make sure it, generally speaking, fits that rule. 20 cents wide once I move the decimals 3 ticks to the left. If it's a stock that is under $100, then we are looking at it needs to be equal, it needs to be about equal to or less than 10 cents wide. And that's for if it's a stock. If the stock is less than $100, then we need to be equal to or less than 10 cents wide. And if it's greater than $100, right, then I said it needs to be equal to or less than move the 3 decimal points. All right, move that decimal point out, 3 decimal points. Okay. So in a sense, if it's a $2,000 stock, right, I move that decimal 3 ticks to the left, then the bid ask should be, equal to or less than $2 wide. Okay. Does that make sense for everybody? That's pretty simple. That's making sure that this underlying is appropriate to trade options. Because you guys, I know there's, how many stocks are out there? I don't even know. There's thousands, 10,000 stocks out there. Not all 10,000 stocks out there have really good option pricing, okay? So make sure it fits that rule. Move the over $100, move the decimal 3 ticks to the left. That's how wide the bid ask should be. If it's less than $100, 10 cents wide or less, okay? And that's on the spot month, closest to expiration during open market operations. Yes, that was a mouthful. It seems like a lot of rules, but they all make sense, right? I'm not going to look at a market that's closed in order to determine my price of what I think something is worth, right? Did I hear you right? Eric, you're not doing an iron butterfly. I am doing the iron butterfly, yes. The short iron butterfly. I will not do a long iron butterfly. I don't believe that I've ever even done a long iron butterfly webinar. And if I did, it was on why not to trade it. Okay. Which I have done a couple of them, not hour long ones, but just like info, real short ones, like don't trade this one because of these reasons. But this one is a short iron butterfly. And yes, absolutely. We love this strategy. All right. So that's picking the right underlying, and the right underlying is equal to or less than 10 cents wide, right? On a, less than $100 stock, and then, equal to or less than the 3 decimal point move rule, right? All right, good enough. All right, so the next one is picking the right environment. Well, we don't even have to do the picking right? This one, the right underlying. We've got that. Now the right environment. I've mentioned this before. We want high implied volatility, all right? And not all implied volatility is created equal. All stocks, whether it's Aeon or Tesla, Tesla has really high implied volatility, generally speaking. You can see Tesla is at or near its low end of its range that it's ever seen. This is implied volatility for Tesla, and it's at 50. Now, that is like an extreme high volatility coefficient for just about any other stock, but it's almost nothing for Tesla. So what we have to do is figure out where this number 52 is in relation to Tesla's past implied volatility, because they all have a tendency to stay in their own ranges. Kind of like, you know, we can look at Tesla, you know, we could say, well, Tesla, generally speaking, stays within this area, right? This would be an extreme high. This would be an extreme low. Well, it rarely gets down there, but it does. Same thing as here on volatility. It rarely gets up there. You know, it doesn't mind coming down here, but it doesn't really go much below this area of 50. But then again, we look at it and it wants to hang out, you know, in and around mid-market, if you would. All right. I do have friends that only go back 6 months and use this as their coefficient. But what I want you guys to come away with is we're trying to figure out where this implied volatility is in relation to where it's been in the past. And what we need to do is take the three numbers we have here, the high, which is, let's call it 110, the low, which we're going to call 48, and the current is 52. So we have a fraction we got to solve for. So we take the current minus the low and take that sum and divide it by the high minus the low. Well, we said the current was 52 minus 48 and divide that by the high, which we said was 110 minus the low, which is 48. So we're trying to find out where 52 is in relation to where the range is, really. So 52 minus 48, we've got 4 divided by 62. Right? Yeah, 62. So 4 divided by 62, that puts us in an extreme low area. So that's going to be 0.06 something around there, right? I can't do the math in my head right now very well, but we can come over here and look at Tesla's thing, and we can see that the earnings percentile, current minus the low, seems a little high compared to what I was looking at for the math, but I was struggling with that math. That seems wrong. But also for some reason, my implied volatility percent over here, every time I do this webinar these days, it's not loading it up. I usually have it in my watch list and actually, you know, list these from high to low on the on my watch list there, so I can tell right away where the current implied volatility is on stuff. We can take a look at something else. Let's just go to IBM on this and just double check the math on this one to make sure I'm not crazy. But we take the, again, take the high. We need the high, which is 40. You know, see, look at IBM. It's high. Extreme high is 40. Not even close to where the extreme low was in Tesla. So we've got 41 as the high. The low we've got as 10. So we get out our problem here and we take the current minus the low and the high minus the low and take those and divide them by each other. So we've got the current is 20 minus the low, which I think I said was 10, and divide that by the high, which was 40, wasn't it? 41, I think. 41 minus the low, which was 10. So our sum is 10 divided by 31. So it is in about the 30th percentile. All right. You can also, if you have Thinkorswim, you can go over here and look at it in the IB percentile here. If you have it as a chart somewhere else, you're going to have to do the math on it. I also have a buddy that will only look back 6 months for the implied volatility, and he figures out all of it for everything. So he will discount what happens, you know, the first 6 months. He only goes 6 months out. I don't have a problem if you do that also, but stay consistent with it, you guys. Make sure that if you're going only back 6 months, you stick with that. Don't sometimes do a year, sometimes to do a 6 months. The only time I would say to change it up is, you know, sometimes we'll see with drug stocks, this implied volatility will kind of go like this, and then you'll get this huge spike like that when they had a trial like a drug trial, that I would say you could strip out and say, okay, well, these are the highs and lows kind of thing, because this won't happen for another 3 or 4 years. Once they come out with another drug trial result, which takes well over a year, sometimes 5 years or more, then you aren't going to see that kind of spike for that particular stock. And that really is something more akin to drug stocks, drug makers and stuff like that. They get some crazy spikes when they have trial results and stuff. Right, so that would be a time where I would say you could discount it going forward, because they're probably not going to have one next week. All right, and why is it really important to have this implied volatility at or near the highs here? I don't want that on there. Why is it important to have it up there? Remember, I said it has a tendency to leak in volatility, and then we'll see that volatility come out really quickly. So when we see it get up or near the extremes, that's when we want to take advantage of that volatility coming out, all right? You can see it happens quite a bit. Well, that's a little bit low, but once it gets above 50, we start seeing volatility start wanting to revert back to the mean, which is right back to where the middle of the road is, really. So that's what we're trying to take advantage of. We want to capture that really high implied volatility, because it makes our analyze tab, or our strategy, look more like this rather than to look like the next slide, this. You can see the difference there. What we want is our risk reward to be almost 50-50 here, but you can see I'm looking at, this is EA Sports, and it's trading at 120, all right? Now I go all the way to my break even, that's $6 down from 120, and all the way up to my break even, which is $6 forward, all right? But what if I was doing this with really low implied volatility? Yes, this is Caterpillar, and I just said all stocks aren't created equal with volatility. All I'm trying to show you is what your strategy would look like if you did it with really low implied volatility. This is a 115 is the middle, and then I go all the way down to 110, $5 down. That's my max loss, right? So you can see that it makes more sense to do it when there's a lot of implied volatility. I'm able to get my break even much further away than I was able to with the stock that has low implied volatility. I have much less wiggle room before I start losing money, okay? Yes, one could say that the risk reward might be a little bit better for this one, but I would say my risk is much greater with this one because I don't have any room to be right. I have all of this room to be wrong, whereas the one right before, I have a lot more room, a lot more movement in either direction in order to still be okay. So that's why, although those are two completely different stocks, they were trading around the same strikes in a sense. That's what I was trying to get across there. We build it when there's high implied volatility, then that triangle gets, stretched out a little bit better. So we want the right environment. We want a triangle that kind of goes like that, right? That's a terrible drawing, Eric, but you get my drift, rather than one that goes like this, right? Yes, one could say the risk reward's better on this one here, but I would say that's a lot of room to be wrong. So I would like to stay away from that. And then picking the right duration. I mentioned this, spot month is 35 days to expiration. So we want to be as close to 35 days to expiration as we can, okay? And right now we are in flux. We're right in between that, where 22 days to expiration is a little tough to get a nice big juicy credit for it. But then 52 days out is also quite a long time to be in a credit spread, the way I look at it. I'd like to get into credit spreads around here because we get a lot of theta contraction coming in. This is where the thief in the night comes and steals our premium, 35 days to expiration here. We get a 50% drop in our premiums on the at the money call and the at the money put. Well, remember, we are going to be selling a call and selling a put that are at the money. So this is a good representation of the theta decay. 50% of the drop happens right here. You can see the flatness. It's almost flatter, a lot flatter out here than it is inside of here. But one thing we also note with volatility, when volatility comes in and pumps up the premium, it kind of does this. Now, if we can time it, then we get that premium decay and the theta, or the premium coming out because of the volatility crush and that theta decay all happening at one time. So it's just like somebody just flushed the toilet on our premiums, which is what we want. We shorted it. We've got a credit. We want that credit to go down. All right. So we want all of these things to come together. That high IV, jumping, pumping it up a little bit, kind of like a balloon. You know, implied volatility is like air in a balloon. You blow it in there, that balloon expands. You let it out, it just, it all deflates back down. All right. So that's what we're looking for. We get the theta component where we get the max theta decay going on. Yes, somebody could say, well, inside of this last 7 days, there's even more than that, Wolfman. Why not just trade it in there? Well, we have gamma going on in here, and gamma can mess up the trade that is at the money, very close to at the money. Gamma is going to affect those options much more inside of these 7 days. So we want to stay away from all of this in here, okay? So try and stay out of that last 7 days if at all possible, all right? Only time I'm really going to write it in past those 7 days is if I'm looking at a max loss already. All right, and then the right strikes. Well, we're selling the at the money. You just said, how hard is that? Well, one thing we're going to be trying to do with this at the monies is we are going to try to do it and get delta neutral, all right? All right, so we want to be delta neutral if at all possible, because remember, we said we are neutral bias, right? So we build this out so we are neutral, or as close to it as we can. You might have 1 or 2 deltas off, and I'll go into all the delta details here in a second. But for those of you who are familiar with delta, we want to try and get it relatively delta neutral. So we sold these at the monies, right? We're selling these at the monies here. Well, we're going to get a credit, all right? Well, how do we find where our defined risk is? One of the first things, easy way to look at it is we take the credit times 2, and then that's where we define our risk, to define it. Risk, all right? So 2 times the credit is kind of where we're going to look to define our risk. That will help us create we want to collect about 50% the width of the strikes, really, okay? That's our goal, is 50% of, you know, we have some wiggle room. You can collect a little bit more, collect a little bit less, but I would not do this with less than a 40% credit on the width of the strikes. That's where you're going to have to start playing around with this, right? We know it's the at the money. We know what the credit is, and then we multiply it times 2 to figure out where we're going to look to start defining our risk. And that's going to fall somewhere between that 2 times the credit or the 10 delta to define it. All right. Define with the 10 delta. All right. So I'll go through a couple of these real quick that we can look at. Throw up an example real quick. Since we're selling a call, do you want defined high IV underlines? Yes. We need implied volatility to be at extremes, but my rule for this is that implied volatility needs to be above 50. And I should have said that for the environment. Implied volatility percent for a stock needs to be above 50. And for an ETF, it needs to be above 30. Now, an ETF is a little bit less because that ETF has a basket of underlyings in there, and those volatilities will have more often than not a tendency to mellow that number out. So to get above 30 is difficult, but anytime it's above 30, it's game to sell. All right. So let me pull up an example that I know has high implied volatility right now, and that's gold. Everybody loves gold right now with the possibility of weak dollar and everything else. So we can go through our steps real quick. Picking the right underlying, right? Picking the right underlying. Look at the spot month. It's this August. Move the decimal 3 ticks to the left, 13 cents. Come down here. You can see GLD easily fits that rule. Even when the market's not open, we would normally look at this during open market operations, but it still fits the rule even outside of it. Now, I told you we're going to be looking to try and sell the at the monies. The ones that are probably close to at the money is these 133.5. So that's what we'll go with. I usually like to use the rounded ones, but we'll do it anyway. All right. So we've got the 33.5s. 2 times the credit received is kind of like what we're looking for a distance. So we're looking for about $7 down and $7 up. So we might not even have all the half strikes up there. So I'm just going to go $7 up, which would be the 40.5s. You can see it's lining up very close to the 10 delta already. We're going to buy that one. $7 down to the downside. It's not going to give it to me. All right, so $7 to the downside, I would have to go to 126, 126.5 is what I need. And we are seeing a lot of skew. You know, this would be a great webinar on skew because you can see on this one with GLD, excuse me, I'm going to go to the, I'm just going to do the 134s because I want to do the 134s because I want to be able to have an even number here. All right, so I'm going to go 134s. And then I'm going to go down to that 127 and then go to the upside. So I went 7 to the downside. I'm going to go 7 to the upside just to keep it even and buy that one. So I bought the 34, sold the 34s, bought the 41s, sold the 34s, bought the 27s. So we're equal distance apart on this, all right? I've defined my risk. Now I've got $7 wide. I said I needed to collect about 50% the width of the strikes. You know, it's very close, $3.80, $3.50 is really what we're looking at. Let's just see if we can get that done with the 3.5s, get a delta neutral, more delta neutral. So I've got $3, so $7 up, $7 down. We already realized we can't do that. So let's go $6.50 down and go to the 127s. Buy that one. $6.50. The upside is the 40s, right? You guys can double check my math. So we've got $6.40. So it's just slightly less than that. You know, great case would be able to collect 50% the width of the strikes, or maybe even a little bit more would be great. But as we want to shoot for 50% the width of the strikes. That's close enough for government work at this one. Your options pup is present and accounted for. Thank you, Rick. Good to see you. The pit bull, Marty Schwartz, would say, skew you. There is a lot of getting skewed. People are getting skewed, especially in gold. Because you can see the skew is to the upside because I'm doing equal distance apart. And the probability of getting this 127 is only a 5% probability. And the probability going this much higher is a 12% probability. So people are leaning, feeling the risk is to the upside in GLD. All right. All right, so that would be picking the right strikes. Yes, it's easy to go at the money or these at the money, but then the idea is do double the credit. All right, so $7 is kind of like where I need to start and then move my way in, or around that $10 or that 10 delta option. So usually it's going to, my two rules are going to land you somewhere right in between here, okay, right around in there. So it just gives you the ballpark to get there, all right? So pretty simple that way. So that's picking the right strikes, making sure we collect about 50% the width of the strikes. That being said, it's going to line up with the delta of around a 10 delta or, you know, somewhere inside. It's going to have to be inside 2 times the credit because think about it, you're going to have to pay something for those different strikes. So let's review real quick. The right environment is implied volatility percent of greater than 50 for a stock, and then IV percent greater than 30 for an ETF. All right. The right underlying is, you know, the 3 decimal rule, 1, 2, 3 decimal rule, or less than 10 cents wide. The duration we want is as close to 35 days to expiration as we can get. And picking the right strikes, we want to try and get 50% the width of the strikes. Right? And then our exit strategy. Our exit strategy is 30% of max profit. All right? And why we want 30% max profit? Because remember that whole thing with the at the monies, right? At the monies are going to have a little bit more volatility. They're going to take a little bit more time. So for this to work out, we are going to have to settle for a little bit less. But look, this is one of the premium selling strategies. You collect the most money. All right. So I'm never trying to get the full boat out of any strategy. I don't want to. I want to play the probabilities. And when I see the probabilities are in my favor, dump it. All right. I'm not going to let those probabilities play out because they are likely to end up being worse than where I currently am. So get out early. 30% of max profit. If you have a little bit less risk tolerance, maybe 25% of max profit. So, you know, in that one we were looking at, it was a $3 credit, let's say. Well, 30% of max profit, when this is trading $2, I get out. Right? Does that make sense? Pretty simple. Also, with this strategy, like I said, it takes a long time to get out of this strategy. And if you are having if you have a lower risk tolerance or newer to this options trading stuff, then go with this. If you're only in this trade for less than 10 days, then get out if you're at 10% of max profit. All right. If it's less than 15 days, 20%, less than 25 days, and you're at 30% of max profit, get out. If you have a higher risk tolerance, I would get out at the 40% of max profit and run like the wind. Okay. I am going to get out at the 30% of max profit. Okay. That's where I'm shooting for. And what is our max profit? We've been talking about max profit forever. Well, it's the premium received anytime minus your commissions. Everybody has different commissions, so I don't know what that is for you guys. I also say at the beginning of every year, you should call up your trading company or your brokerage firm and tell them to lower your commissions. I wouldn't do it every week or every month or every quarter, but once a year, call them up and say, hey, this is how much I've traded. This is how much I gave you guys. Give me a break. And they will. All right, so premium received is your max profit. Now, our max loss, you can look at it. We have 2 different max loss potentials, right? Because the market can go up and we have max loss. Market can go down, we have max loss. Well, but it can't go in both directions at the same time. So basically, it's the width of the spread minus the premium, or the width of the spread on the downside minus the premium. You can look at. We're going to have equal distance spreads. Yes, you can wiggle it a little bit and kind of jive around if you are a more savvy trader and have unequal wings if you want. I don't have a problem necessarily with that. If you are a very savvy trader and are really trying to get to delta neutral and all of that stuff, then I don't have a problem with that. But otherwise, I would stick with these rules. All right. And then our break even is the short strike, which is our at the money, right? Plus the premium. Because remember, we collected a credit. So it's that short strike plus the credit, or the short put minus that credit. Because that short or that credit gives us wiggle room to the downside, just like that credit gives us wiggle room to the upside. And I'll go over a couple more examples here to make it a little bit more clear for you guys. And also, this is part of the webinar where you guys throw out stocks you want me to look at for your that you guys are looking at. See if it, we'll just go through it. Hey, I'm market neutral in this underline. Let's see if it works out. All right. So I did the GLD one, right? We don't need to go over that one. That was pretty darn close to fitting all those rules. Another one we could look at is Booking.com. Now they have earnings coming out. So anything that has an earnings, we need to stay away from. But we can see that it has pretty high implied volatility percent, I believe, 70 IV percent. So, you know, if you do the math on this, you're going to get about a 70 IV percent. Above 50, we can start selling premiums. Well, the reason why I wanted to look at this example, because this would be a perfect example of something where, you know, you get the market to move and then it settles down. That's exactly what I was kind of talking about, right? You know, there's going to be overhead resistance here. I think it's going to want to hang out here. I don't believe there's any earnings in the month that I'm going to be trading here, okay? So I'm not worried about earnings. Yes, there is an earnings in here, but we're pretending there's not. But I believe it's going to start settling down here, and I am market neutral, and it's got high implied volatility. Well, that starts leading me down the road of, all right, well, I can trade this. Well, can I trade this? I don't know if I can trade this one yet, can I? So it's a $2,000 stock, move the decimal 3 ticks to the left, $2 wide, around $1.90 is really where it's at. But we're going to the spot month, which is the one where the most time and volume's been spent. And then we look here and move the decimal, see if it's $2 or less. Right here, we're looking at more than $2. During open market operations, a lot of these will fit that $2 on the spot month with Booking.com, believe it or not. Not every day, but most times it will. But with that being said, if we were going to look at this, to build this out as a market neutral strategy, here's something to know. When I'm doing this, if I'm going to sell the 135 strike right here, okay, I'm selling this strike. So I am selling 51 deltas, which means that I am now negative 51 deltas, right? And if I sell this option strike here, well, I'm selling this delta. So that's a negative, and a negative makes a positive, right? So that means I sold negative 51 deltas and I got 49 deltas. I am now negative 2 deltas. Does that make sense? So right now I'm already negative 2 deltas. I'm negative 2 deltas on that. And then if I were to do this collection, I would probably have to do it on a different screen because I'm not going to have to scroll it back and forth. But that's how we figure out the deltas. And again, if I went out here and bought, let's just say it's not going to fit this rule, but if I bought this delta, right? If I'm buying this strike to define the risk, well, I am buying negative deltas, so I'm still negative 36 deltas. And then if I came up here and I bought this one to define it, well, I'm buying 31 or I'm buying 34 deltas, so that's positive. So plus 34 deltas minus 36 deltas, well, I'm negative 2 deltas there. Okay. So I'm overall going to be negative 4 total deltas, but that's pretty close to neutral. All right. So that's how you kind of add up those deltas as a real quick reminder for people. I think I forgot to mention that in the last webinar there. So make sure I mention it here again. We'll do a rundown one last time with GLD. Actually, I'll do a different one. I'll do GDXJ, which is basically the junior gold miners. It's a $38 stock, so it's less than $100. We need to make sure these markets are inside of 10 cents wide. Yes, you could use weeklies, but the weeklies, if you are going to use weeklies, it needs to still fit that rule of being inside that 10 cents or move the decimal 3 ticks, okay? That fits this. This still fits it, so you could do it here as well. But I'm going to look at it on the 39s. It's pretty close for government work. Those, it's a pick 'em really. All right, so selling both of those, I've got $2.80. So I'm looking at somewhere, a little bit around $5. So I subtract $5, looking for that 10 delta. So $5 puts me there. $5 to the upside puts me at 44. Buy those. So I've got $5 wide, $2.50. That fits that rule, right? So we're good on that. Now we can check the deltas, right? So I did those 39 deltas, or the 39 strikes. That's negative 48, right? Selling 48 deltas is negative 48, and selling negative 53 deltas. Well, that makes me a positive 53 there. So 53 minus 48 gives me 5. So I am overall net long 5 deltas there. I bought these, so that puts me at negative 13 deltas. And then I bought these, add back in 11 deltas. So I'm overall negative 2 deltas. Not a big deal. All right, that's about as close to neutral as you're really ever going to get, a couple of deltas off. We can go over here and look at the Analyze tab. Take off this old example. And you can see we got really wide, flattened out Analyze, right? This looks great. This is even wider than the one that I showed you for the EA Sports. So it allows us to get really far away rather than having, when this is in low implied volatility, it's going to kind of look more like maybe this, right? Where your wiggle room is much tighter before you get to the break even. Yeah, your max loss might be a little bit less, but, you will notice that the break even happens here where my break even happens way out here at this strike. Well, if I did it in low implied volatility, I'd be at a max loss. So stay away from it. There's better option strategies for low implied volatility than something like this, where this is perfect for really high implied volatility and you expect it to kind of settle down.